we talk macro on the show a lot, and probably sometimes viewers are tired of it. I'll just say that the data this morning was awful. The industrial production numbers were terrible. Retail sales were terrible. And even the PPI dynamics, while they show year over year, we're down to 6.3 versus 7.2 where we were in November. There's some elements of the PPI that actually indicate that there's going to be some stickiness to the parts of the services and the labor piece. So we've had a great run. We've had a great run really since December 28th. We've talked about this, whether it's the most cyclical or the most bombed out or even just the highest multiple parts of the economy. Bad news was bad news today. The only good thing out there for people that are wishing on the largest market cap stocks in the market, the FANG, the top 5 or 6 stocks, is that the 10-year got down to 328 today. And so people that are looking at the slower growth dynamic as a place to buy defensive stocks, I think that's and I think we've outlined that as being a mistake to believe that that's safety net. But again, to me, it was a day. It wasn't so much that the market ran out of gas. You were reminded front and center that big, important data pieces of our economy are slowing aggressively.
Yeah, and we were also reminded about where the Fed is headed, or where the Fed wants us to believe it is headed. James Bullard reiterating once again that that rate could go as high as 5.5%. And so I was chatting with Steve Leisman earlier today on the exchange, and we're noting how there's a huge discrepancy between what the market is pricing in and what, if you take Bullard's word, the Fed is pricing in. That could be as much as 78 basis points of difference in terms of where we see that terminal rate. That's huge.
But market participants are conditioned to know when we have this sort of weakening, what does the Fed do? And they pivot, right? And so that's really the thing. So we've been debating, and last night on the desk, we talked about this hard landing, soft landing. What's consensus now? David Rosenberg of Rosenberg Research tweeted this out after the data this morning. Sorry, folks, no soft landing. On track for 3 straight quarters of declines in real retail sales alongside 2 successive negative production numbers. Only happens in recession. So the point is, if the consensus is, and why we've been rallying over the last, let's call it 2 weeks, is that a soft landing, we can handle that. We can handle higher rates. The dollar's coming in, the inflationary pressures that are coming in, that's all good. I mean, some of this data might be accelerating to the downside, and I think that's the reaction of the market, especially as we go into earnings season, because I think when you see the sort of acceleration in job cuts by some of these big companies, they're trying to tell you that we need to signal that we're going to get costs under control, because rate environment, everything else, just the headwinds to growth are going to be the sorts of things that we have to start operating in a recessionary environment. And right now, I don't think the market is pricing that. So to me, I think that you want to take this stuff seriously, and earnings are really going to be front and center, obviously, over the next 3 weeks at a time where we're also going to get a lot of Fed 1 meeting, and then, we have the meeting quickly in mid-March.
So there's obviously been this dash for trash, kind of, right? Anything that was really high multiple and had a terrible last year was doing really well at the beginning of this year. I mean, 600, it's a big move, but we're only back to where we were, I don't know, a week ago or so. So I'd actually prefer for the market to be down going into earnings rather than up, just because the bar is lower. I mean, if you're right and we are headed into a recession, and that's what, if you go out the curve, that's what it's telling you, then I think the market has some ways to come down. But I always come to the point of, it's not a monolithic one stock. Some things I think are going to do fine, and some things I think are not, and some things I think might do okay, but have run so much already. Netflix might be one of them.
Yeah, I mean, closer to 4,000 on the S&P 500 during earnings season. There's less room for things to go wrong, Guy, than where we are now, 39.25 or so.
Yeah, exactly. And, Tim hit the nail on the head. Bad news today, at least, was bad news. But by the way, the knee-jerk reaction to a lot of those numbers this morning, the market was actually higher, as I know you know, but the board comments threw some cold water on things. And I think they're doing that for a reason. They're really trying to condition the market that, hey, we're pretty serious about what we're saying. So the good news is, to Karen's point, we're still about 100 or so S&P points higher than where we started the year. So it's not disastrous by any stretch of the imagination, but now you're starting to see, I think, the effects of the Federal Reserve's raising rates. Things are starting to slow precipitously. And in this environment, again, my opinion, lower 10-year yields are not bullish. And, I think you could see a scenario where 10-year continues to go lower from here, where the 2-year can remain pretty sticky around 4%. So if you get a 1% inversion, which is not out of the realm of possibility, what do things look like there? That, to me, has to be one of the concerns.